Hi, this is Janet Nation from Keller Williams, and today I want to talk to you about preparing yourself for home ownership. So if you're looking to purchase a home this year, I want to give you some tips on what you need to do so that you could be mortgage eligible. And if you like the information that you're hearing today, please subscribe to my channel where I will be talking about anything and everything pertaining to residential real estate. So it's really an exciting time when you've made that decision that you want to purchase a home. But what are some of the things that a lender is going to take into consideration before you are mortgage eligible? Well, I'm going to share some of these things with you today, and in no particular order. So number one is the lender is going to look at your credit score. So your credit score is, they don't take all three credit scores from the credit bureaus and add them up and divide them by 3, and that's your credit score. They actually take the middle score from the 3, and you want that middle score to at least be 640. Now, it can be lower. I think it can be as low as 580, but that's not the way you want to go, because at 580, yes, you can still get a mortgage, but rest assured you will have received the worst possible terms. High interest rate, maybe a heavy down payment. It's just not the way to go. I mean, you got to get your credit score to at least a minimum of 640, right? Then the next thing the lender's going to look at is your debt. How much debt do you have? And then when I say debt, I'm not referring to your total dollar amount. What the lender's going to look at is your monthly minimum payments from each category, from each credit card, from whoever you owe. What is the monthly minimum payment? That's what the lender's going to look at for part of the calculation. And that goes hand in hand. The third thing is your income. It kind of goes hand in hand with your income, because the lender's going to look at how much income do you make? How much income do you make in relation to your debt? And income can and will include overtime that you have done over the past 2 years. So what they do is they take the overtime and they average the overtime out. So for example, if you make $100,000 and you did, last year you did, because this video now has been created in March, let's say you did $20,000 in overtime over the last 12 months. The lenders don't look at 120 as your income. They're going to look at the overtime that you did the prior year, and they average it out, and then they add that onto your base salary. So they come up with this formula called debt to income ratio. How much debt you have in relation to your income, in relation to the house that you are looking to purchase. These numbers are really, really important to have. And it's going to make, for many people, the big difference between whether you can qualify for a home or not qualify for a home. The lender is going to be looking at your work history. So let's go back to talking about work. It's going to be looking at your work history. Want to know that you have been working for at least 2 years. There are exceptions. For example, if you just came out of college and you're going into a field that you got your degree from, they'll make exceptions there. But typically the lender wants to know that you are working for 2 consistent years. Again, some exceptions, maybe a little gap, you had a baby or something of such, but 2 consistent years is what you want to bear in mind that the lender is going to be looking at. Next, your assets. How much savings do you have? How much savings do you have? Now, the things to take into consideration when we're talking about savings, we're talking about your down payment, your closing costs, money you have to leave in escrow, You've got to pay, you got to have enough money to pay the home inspector. People don't think about these things. You've got to have enough money to pay the home inspectors, the attorney, your appraiser, or the appraiser. All of these things, you've got to have enough income to do these things, and you've got to have reserves. You can't be using every last penny. The lenders do not want to see that you're using every last penny that you have to purchase a home. So you've got to make sure there's enough money to cover these things. Right, so when you put all these things together, your credit score, your debt, your income, your work history, the assets you have, and the price of the home, this is what the lender is going to now determine if you are mortgage eligible, and if you are, how much. You know, there's something I really should add when we're talking about the price of the home, also the taxes. Because if you're in Long Island, where I am, the taxes are going to be significantly more than if you're coming, if you're looking to purchase in Brooklyn and Queens. Right, so those things really also are going to be taken into consideration when the lender is looking at the price of the home. So back to what I was saying before, so it's going to take all these things into consideration and going to determine how much you can afford to purchase a home. So if you want help, I've been doing this for a very long time. I have a handful of lenders that I have been working with for a very long time, and I'll be more than happy to send you to them so you can get specific information about your personal needs. All right? So if you like the information shared today, please subscribe to my channel. And again, I will be talking about an array of subjects pertaining to residential real estate. Bye for now.